Welcome to This Explainer. If you've been following the streaming wars, you know the media is absolutely obsessed with one shiny metric, and that's subscriber growth. But today, we're tearing up that playbook. We're looking right past those basic subscriber numbers to uncover the actual, real financial engines that are driving Netflix, Amazon, Disney, and Warner Bros. Discovery. Okay, let's dive into this. It's super tempting to think that whoever has the most subscribers is automatically winning, right? But treating a pure streaming company the exact same way you treat a massive e-commerce giant is a huge mistake. The real winners here are relying on structural advantages, hidden cash flows, and just entirely different playbooks. So here's our roadmap for today. We're going to start off by meeting the giants. Then we'll run them through the Buffett moat test, unpack the 7 valuation models, categorize them using the Lynch growth classifications, and finally, we'll wrap up with our final verdicts.
Section 1. Meet the giants. Different playbooks.
Now, there is a stark contrast in how these behemoths operate. Take Netflix, with over 325 million subs. They are what we call a pure play, meaning streaming is literally their only game, and efficiency is their main weapon. But then you look at Amazon, and streaming is just a loss leader to get you hooked into their massive Prime ecosystem. Disney? They're using this massive omni-channel flywheel, where they turn a casual movie viewer into a lifelong vacationing theme park customer. And then we have Warner Bros. Discovery, using their 100 million subs mostly to optimize IP licensing and desperately chip away at their debt.
Section 2. The Buffett moat. Testing protections.
Warren Buffett's core investment checklist really hinges on this one concept, the economic moat. It's basically a structural advantage. Think of it like an invisible castle wall that protects a company's long-term profits from rivals. Today, a moat isn't just about physical assets or having a recognizable brand. We have to look at modern moats, like AI data clusters and algorithmic lock-in, to figure out who actually survives long-term. And when we stress test these companies, the differences are just glaring. Amazon has a very wide moat. Why? Prime ecosystem lock-in. I mean, think about it. A user isn't going to cancel their Prime membership over one bad movie because they still need that free shipping and those cloud services. Contrast that with Warner Bros. Discovery. Even though they own massive prestige libraries like Harry Potter and HBO, their moat is incredibly narrow. They are taking heavy hits from legacy cable cord cutting, and it's forcing them to license out their absolute crown jewels just to stay afloat.
Section 3. 7 valuation models. Inside the vault.
Because these businesses are just so wildly different from one another, relying on a single financial metric is genuinely dangerous. We have to use multiple valuation lenses. You can't evaluate a theme park company using a simple discounted cash flow, projecting out future cash, the exact same way you'd evaluate an asset-light tech platform using EV to EBITDA, which really looks at pure operational earnings. It's not apples to oranges, it's an apples to spaceships comparison. To put this into perspective and show you exactly why this matters, consider this number $59 billion. That is Amazon's recent trailing increase in capital expenditures. That's the hard cash they are dropping on physical assets. You really can't judge their standalone streaming cash flows clearly because the whole thing is completely obscured by their massive investments into new 2026 AI clusters and AWS data centers. For them, streaming is just one tiny gear in a much larger machine. And this brilliantly illustrates the massive divide between pure tech and legacy media. Netflix gets to enjoy really clean, unleveraged cash earnings that are based on software and algorithms. They get a premium EV to EBITDA multiple. But Disney? They require a split valuation model. You literally have to separate the long, multi-decade math of building billion-dollar cruise ships and theme parks from the rapid, short-term cycle of funding a streaming TV show. They are essentially two entirely distinct businesses operating under one roof. Then, of course, we have the $33.4 billion elephant in the room for Warner Bros. Discovery. This staggering gross debt just severely drags down their valuation. Even though they are generating real, significant adjusted EBITDA, the market treats them like a distressed asset. Their entire valuation essentially hinges on one thing: using every spare dollar they have to pay down that chain around their neck as fast as humanly possible. Section 4. Lynch Growth Class. Categorizing Cycles. The legendary investor Peter Lynch loved to bucket companies, so he knew exactly what growth cycle they were in and what to expect. If we update his framework for today's market, Netflix is a classic stalwart. They're past their hypergrowth phase, and they're now delivering steady, predictable revenue. Amazon? They are a fast grower, but driven by cloud velocity, not streaming. Disney falls into the turnaround or cyclical category, relying heavily on those theme park cycles to fund their streaming restructure. And WBD is a pure asset play, a modern turnaround scenario where those massive studio assets are just sitting there waiting to be unlocked. Section 5. Final verdicts, summarizing winners. So where do we land? Well, the overall growth winner is undeniably Amazon. The key takeaway here is that their streaming division is essentially a rounding error on their balance sheet. They win the growth game because their media ambitions are fully bankrolled by the sheer structural dominance of AWS cloud computing and their high-margin retail ad engine.
The execution winner for sure is Netflix. Years ago, critics absolutely insisted that pure streaming could never be profitable. Well, Netflix proved them wrong. They transitioned from a tech disruptor into a true media utility, pushing their operating margins to nearly 30%. Their execution and cash generation at a global scale is simply unmatched.
The Balanced Flywheel Award goes to Disney. If you're out there looking for a long-term recovery bet, Disney represents structural, generational IP. They have the unique ability to cushion the messy, expensive transition of streaming by selling out their physical theme parks and moving merchandise, which creates a really highly insulated ecosystem.
Finally, the deep value leveraged play is Warner Bros. Discovery. This is your classic high-risk, high-reward setup. Yes, they failed the Buffett moat check due to those legacy cable headwinds, but the sheer size and quality of their prestige library makes them a fascinating asset. It's a pure valuation play. If management can successfully chip away at that $33 billion debt pile, the stock equity could re-rate significantly upward. So we've moved far past simple subscriber counts today. We've looked at economic moats, complex cash flows, and modern growth cycles. These entertainment giants are all fighting the exact same war, but they're using completely different weapons. So based on the real valuation mechanics we explored today, which strategy are you betting your portfolio on? Thanks for joining me on this explainer, and I'll catch you next time.